In a sudden move that surprised market participants, metal and mining baron Anil Agarwal has announced a proposal to buy out minority, non-promoter shareholders of Vedanta Ltd and delist the firm from the domestic stock exchanges. Here's all you need to know. Let's start with the basics first and understand what do we mean by delisting of shares. Well, delisting a company's share means that it's permanent removal from the stock exchange platform wherever it is listed. Simply put, post delisting, the share can no longer be traded on the exchanges. Delisting of shares fall in two categories: voluntary and involuntary delisting. Involuntary delisting happens when the company or any company fails to adhere to regulatory norms or goes bankrupt and the authorities step in overnight. Vedanta Ltd is an example of voluntary delisting. Now, the promoter group holds 50.14% stake in the firm and is planning to buy out 48.94% non-promoter shares with the market cap based on its May 11th closing price pegged at 33,194 crore rupees. So what's the process of voluntary delisting? Well, in instances of voluntary delisting, a firm removes the share from the exchange on its own and makes payments to the existing minority shareholders, usually at a premium to the current share price, to return the shares that they are holding. Now, the delisting is considered successful only if the shareholders of the acquirer and the shares offered by the public shareholders together make up 90% of the company's entire share capital. Voluntary delisting doesn't happen suddenly and investors have sufficient time to sell their shares and exit. For instance, SR Oil delisting process, first mooted in 2014, took 4 years to conclude amidst the regulatory hurdles and opposition from the shareholder advisory firms. So what price will shareholders get for their shares of Vedanta? Well, the promoter Vedanta Ltd has proposed an indicative offer price or floor price of 87.5 rupees per share, which represents a 9.9% premium over the closing market price of 79.6 rupees per share as on Monday. Now, but this is not the final offer price for the delisting. Now, the final offer price is determined by appointing a merchant banker who carries out reverse book building. Reverse book building is also a price discovery method in which bids are taken from current minority shareholders and the final price, which normally exceeds the market price, is fixed based on the nature of the bids. So why is Anil Agarwal delisting Vedanta right now? Well, corporate simplification is the trigger behind this delisting move, says the firm. Experts see this as an opportune time for the promoter group to really lap up shares. The share price has nearly halved from its 52-week high levels and has plunged from 150 rupees levels to the current range in the last 6 months alone. The delisting of Vedanta Ltd will provide the group with enhanced operational and financial flexibility in a capital-intensive business and is also expected to support an accelerated debt reduction program in the medium term. Vedanta Resources, the parent group, has a $1.9 billion debt repayment coming up in FY21 along with a regular interest payment, and therefore the group's strategy to meet these obligations and to fund the delisting will be closely watched by market participants. After all, the external environment is riddled with uncertainty right now. So what's next? Well, if you see, the board of directors of Vedanta Ltd are scheduled to meet on May of 18th and either approve or reject the delisting proposal after taking into account various factors, which include the due diligence report submitted by the merchant bankers, as well as the company will also require approvals of minority public shareholders by way of a special resolution adopted through postal ballot. Now, this would require at least 2 times votes in favor of the delisting proposal. Meanwhile, the management will also be keen to whip up an all-important secret sauce for this deal that's reaching a middle ground between their share price offer and the shareholders' expectations.